Hi everyone, good evening. We wait for a minute while people are joining and then we start the call. Good evening everyone. We are just waiting for a minute while people are joining the virtual call. Vivek, we have 70 people with us. We can start the call now.
Thanks, Anand. Hi everyone, good evening and welcome to InfoEdge India Limited Q3 24 results conference call. As a reminder, all participants' line will be in listen-only mode and there will be an opportunity for you to ask questions after the presentation concludes. Should you need any assistance during the conference call, please raise your hand on your screen. Please note that this conference is being recorded. Joining us from the management side, we have Mr. Sanjay Bikhchandani, Promoter and Vice Chairman, Mr. Hitesh Oberoi, Co-Promoter and Managing Director, and Mr. Chintan Thakkar, Chief Financial Officer. Before we begin today, I would like to remind you that some of the statements made in today's conference call may be forward-looking in nature and may involve some risks and uncertainties. Kindly refer to slide number 2 of investor presentation for detailed disclaimer. The audited financial statement, other schedules on segmental billing, revenues, along with data sheets have been uploaded on our website www.infoedge.in. Now, I would like to hand over the conference to Mr. Hitesh Oberoi for his opening remarks. Thank you and over to you, Hitesh.
Thank you, Vivek, and a very good evening, everyone, and welcome to our Q3 24 earnings call. We will start with an update on standalone financials, and then we'll cover the segmental financials along with the commentary on each business, and then we'll have time for Q&A. Starting with a summary of standalone financials for the quarter ended December 23 and for the first 9 months of FY24. The third quarter of the fiscal year 24 witnessed moderate growth in both revenue and billings on a standalone basis, backed by a strong performance in the non-recruitment businesses. In Q3 of FY24, our standalone revenue was rupees 595 crore, a year-on-year growth of 7%, and billings were rupees 577 crores, a year-on-year growth of 5%. Deferred sales revenue at the end of Q3 was rupees 925 crores, a year-on-year growth of 11%. For the first 9 months of FY24, revenue and billings were rupees 1,773 crores and 1,669 crore, a YOY growth of 11% and 3% respectively. The revenue and billings for standalone business, including Zwayam and DoSelect, were rupees 614 crores and rupees 596 crores, a year-on-year growth of 7% and 5% respectively. 9-month FY24 revenue and billings, including Zwayam and DoSelect, stood at rupees 1,819 crores and 1,715 crore, a growth of 11% and 3% respectively. Operating expenses for Q3 grew by 7%, and for the first 9 months of FY24, operating expenses grew by 6%. For the standalone business, operating profit was rupees 219 crores in Q3 of FY24, a year-on-year growth of 7%, and was rupees 646 crores in the first 9 months of FY24, a year-on-year growth of 22%. The operating profit margin for the quarter for Q3 was 36.7%, in line with Q3 of last year. And for the first 9 months of FY23-24, the profit margin improved by 328 basis points year-on-year and was 36.5%. EPS before exceptional items for 9-month FY24 stood at rupees 49, a year-on-year growth of 23%. We generated an operating cash of rupees 272 crores in Q3 of FY24, a year-on-year growth of 13%. The cash balance of InfoEdge, including wholly owned subsidiaries at the end of December 23, stood at rupees 3724 crores. And the headcount as of December 31, 2023 was 5,602. Moving on to segmental performance, and we'll start with the recruitment business. In Q3 of FY24, revenue for the recruitment solutions business was rupees 451 crores, a year-on-year growth of 3%, and billings were rupees 429 crores, a nominal degrowth of 1% year-on-year. For the first 9 months of FY24, revenue was rupees 1,353 crores, a year-on-year growth of 9%, and billings were rupees 1,258 crores, a YOY degrowth of 1%. Operating expenses for the quarter grew by 14%, And for 9-month FY24, expenses grew by 14% or grew by 12%. PBT for the quarter was lower by 3% year-on-year to rupees 259 crores, and PBT margin was 57.6%. For the first 9 months of FY24, PBT grew at 7% year-on-year to rupees 793 crores, and PBT margin was 58.6%. The business generated operating cash for rupees 277 crores in Q3 FY24 and rupees 751 crores during the first 9 months of FY24. The JobSpeak index for overall, the average index for Q3 was down 14% year-on-year. The softness in IT hiring continued in Q3, and it also impacted our consultant business. Non-IT hiring continued to grow during the quarter, particularly in segments like healthcare, pharmaceutical, manufacturing, and BFSI sectors. The recruitment business witnessed sound renewal rates during the quarter. The Naukri Gulf business, on the other hand, reported a growth of 28% during the quarter, primarily led by growth in new customers added to the platform. Other verticals like Naukri Fast Forward and IM Jobs witnessed healthy billing growths of 19% and 22% year-on-year, respectively. The Naukri database now comprises 95 million resumes and continues to grow 9% year-on-year. Daily app installs on the Android platform grew by 10% and on iOS by 29% year-on-year. The overall app installed base stands at 14 million. We continue to make investments in AI and machine learning to augment improve the user experience on our platform, and we continue to focus on developing strong product offerings like Job Hai and Ambition Box to supplement and complement the Naukri business. And we are actually already sort of opening new branches as we speak in Tier 2 and Tier 3 cities to expand our coverage to more towns and cities. Moving over to the real estate segment, in Q3 of FY24, revenue was rupees 89 crores, a YOY growth of 22%, and billings for the period stood at rupees 88 crores, a YOY growth of 24%. For the first 9 months of FY24, revenue was rupees 259 crores, a YOY growth of 24%, while the billings were rupees 254 crores, a YOY growth of 22%. Operating expenses for the quarter in our 99 acres business were up 5% year-on-year, and for the first 9 months of FY24, expenses grew by 2% year-on-year. YOY operating losses were down 44% from rupees 26 crores in Q3 of FY23 to rupees 15 crores in Q3 of FY24. For the first 9 months of the year, operating loss was down to rupees 554 crores versus rupees 96 crores in the first 9 months of FY23. The operating cash loss was lower in Q3 of FY24 and stood at rupees 7 crores versus rupees 20 crores in Q3 of FY23. Cash loss for the first 9 months of FY24 was rupees 43 crores. Growth momentum in real estate continued in Q3 on both the primary and the secondary side. Despite a considerable YOY increase in home prices, the demand from end users remains strong. Unsold inventory levels continue to remain low in the top 8 cities of the country, and many developers continue to launch new projects. Of late, we are seeing more and more business move towards channel partners for new project sales, and demand continues to surpass supply in resale and rental markets across major metros. Monthly rentals reached record highs in specific metro markets such as Bangalore, Pune, and NCR. Billing growth in 99 acres was primarily led by an increase in broker engagement on the platform. With an increased focus on creating value adds and gradual price rationalization of platform services, our listing realization has improved quarter on quarter. Overall, daily active users improved by 25% year-on-year during the quarter, and responses from the platform grew more than 20% across different categories on 99 acres. We will continue our investments to expand our user base, enhance the platform experience, create unique content, and drive monetization. Additionally, we will deploy more AI and machine learning to augment user experience, fraud, spam detection, and improve search results on the platform. Moving over to the matrimony business, in Q3 of FY24, revenue from Jeevansathi business was rupees 22 crores, a YOY growth of 23%, and billings were rupees 20 crores, a YOY growth of 19%. 9-month FY24 revenue was rupees 61 crore, a YOY growth of 4%, and billings were rupees 59 crore, a YY growth of 14%. We continued our focus on optimizing marketing expenses and reduced the same by 39% year-on-year in Q3 of FY24. Consequently, our total expenses for the quarter were down 19%. For the first 9 months of the year, expenses were down 22% year-on-year. YY operating losses were down by 48% from rupees 26 crores to rupees 14 crores in FY24. For the first 9 months, operating loss was down to rupees 49 crores versus rupees 83 crores in the first 9 months of FY23. The operating cash loss was lower in Q3 of FY24 at rupees 11 crores versus rupees 27 crores in Q3 of FY23. Cash loss during the first 9 months was rupees 46 crores. We continue to maintain our focus on improving monetization and reducing burn in this business quarter on quarter. Moving on to our education business, Shiksha.com. In Q3 of FY24, revenue for the quarter was rupees 34 crores, a year-on-year growth of 23%, and billings were rupees 39 crores, a year-on-year growth of 41%. For the first 9 months, FY24 revenue was rupees 100 crores, a year-on-year growth of 18%, and billings were rupees 98 crores, a year-on-year growth of 18%. Operating expenses for the quarter were up 22% year-on-year, and for the first 9 months of FY24 were up by 26% year-on-year. The business for the quarter reported break-even with a nominal profit of rupees 10 lakhs. The first 9 months of FY24, the operating loss in Shiksha was rupees 3.6 crores. The business generated operating cash of rupees 15 crores in FY23-24 and rupees 10 crores during the first 9 months of FY24. Higher billings during the quarter were propelled by early campaigns from some domestic customers, and the impact may be transitionary in nature. We continue to make investments in this business to improve our user experience and to create high-quality, student-friendly content. Moving on to the consolidated financial highlights of the quarter. At the consolidated level, the net sales for the company stood at rupees 627 crores in Q3 of FY24 versus rupees 590 crores for Q3 of FY23. At the consolidated entity level, the total comprehensive income stands at rupees 2624 crores compared to a loss of rupees 400 crores in the corresponding quarter ending December 23. After adjusting for exceptional items, the profit before tax in Q3 of FY24 was rupees 185 crores compared to a profit of rupees 511 crores in Q3 of FY23. Thank you. And that's all from us. And now we're ready to take any questions that you may have.
Thanks, Hitesh. We'll now begin the Q&A session. Anyone who wishes to ask questions may raise hand on the screen. We'll take your name and announce your turn in the question queue.
Yeah, so the first question is from Vivekanand from Ambit Capital. Vivek, go ahead and ask your question.
Thank you for the opportunity. Hitesh, 2 questions here. The first one is on the recruitment business. So you saw a 1% decline in billing, but I also heard you mention about renewal rates. So could you elaborate a bit on how you are seeing this, the growth in this segment? And also, if you could help us understand Naukri India versus overall billing, and perhaps give some thoughts on the fourth quarter, given that there is an element of seasonality in the business. 4Q is generally very strong. So trying to understand how to think about the base here and growth trajectory for 4Q as well as the recovery that you're seeing now.
So, we didn't see any recovery in Q3. Q3 was IT hiring was slow in Q3 as well. What we've been seeing for the last 3 quarters now is a serious slowdown in IT hiring and also in our consultant business, because a lot of the consultants we have on our platform also, hire or used to hire for IT companies. So this business has been hit because IT companies, one, attrition rate is down as far as IT companies go. 2, they've not been adding new people. In many cases, they've been letting people go. So this has impacted our IT business. Of course, we had a very good 2 years before this, and the IT business grew up by more than 100% back then. But in the process, I suspect IT companies also overhired. And now, because demand is soft, they sort of, have some extra sort of manpower. The good news from our standpoint is that from what we hear, utilization at IT rates at IT companies have started improving, and they're now where they used to be pre-COVID. So let's see what happens going forward. The non-IT business continues to grow. But within non-IT also, there are certain sectors that are doing better than other sectors. Sectors like healthcare, BFSI, pharma, manufacturing, engineering, construction. So now what will happen in Q4? Now the Naukri India business, the Naukri India B2 business is, I think, almost, if I exclude the candidate services business and if I take out Naukri Gulf, it's maybe 90% of our revenue, of our recruitment revenue, including Zwayam, including IM Jobs, including, Ambition Box and so on. So that business, of course, the overall business degrew by 1%. So the Naukri India business must have, I don't have the exact number, it must have degrown by 2-3% at least over last year, because Naukri Gulf grew and candidate services also grew by over 15%. Now, what will happen next quarter? What is likely to happen in Q4? Hard for me to say. It's our biggest quarter. You're right. There's a big base. IT growth had started moderating by Q4 of last year. So, I think we grew by 80% in Q1. Last year, our billing grew by 80% in Q1, 55% in Q2, maybe 25, 26% in Q3, and 15, 17% in Q4. So growth has started moderating by Q4, and by Q1 we were flat. Q1 of this year we were flat. So the base is modest, but I don't know how things are going to play out going forward. A lot will also depend on what happens to non-IT hiring. We are also sensing that attrition rate in a lot of the non-IT companies are also lower this year than last year. Not in all sectors, but at least in some sectors. So fingers crossed. Yeah, I mean, we'll know only by quarter end, because what happens in our business is it's a renewal-led business, and a lot of the renewals happen around quarter end, and what we are able to collect at that time will end up determining what happens to billing growth this quarter. I mean, we have set a target of, internally we set a target of growing over last year, but can't say.
Okay, Hitesh, appreciate the detailed commentary. From a non-IT growth perspective, was there any impact that you felt of the impending Lok Sabha elections on hiring intent of the non-IT companies? Because it seems that by looking at the job speak, it seems that the hiring intensity, or at least job posting intensity of the non-IT companies, is also moderating.
You're right, it's moderating. But like I said, some non-IT sectors continue to do better than other non-IT sectors. So we saw reasonable growth in sectors like healthcare, travel, tourism, BFSI, pharma, manufacturing, construction, engineering. So that's, and the other sectors have been slower. But is it linked to Lok Sabha election? Hard for us to say. We don't know. I mean, maybe it's just linked to the fact that because IT companies not hiring as many numbers as earlier, it's easier to get talent at junior level, because talent at that level is often fungible. Especially, talent from tier 2, tier 3 universities. It's like I remember last year, we were approached by a couple of players who hire for banks, and they were like, listen, there is so much demand for IT talent that we're not able to get people who we used to train for banking jobs earlier. And a lot of our trainees used to be actually engineers from tier 2, tier 3 companies. Now, maybe it's easier for them to hire also.
I see. That's an interesting perspective. Okay, my last question is on the real estate market. In last quarter, you had alluded to, you had mentioned one thing, that if the market is growing at a very fast pace on its own, then obviously that doesn't bode very well for intermediaries like you. So, but still, you have delivered very healthy growth in 99 acres.
Yeah.
So, what's really working for you here? And growth seems to be accelerating now. So, could you spend some time explaining to us what's going right for you in this business?
So, I think what you are referring to is the fact that, I said this once, that if it's very easy to sell, then we are not required. I mean, in fact, nobody's required. So if your inventory gets booked, even at pre-launch time, forget about, you don't even need to launch, then no intermediary is required, no broker is required, no platform like ours is required. But the real estate market is a large market, and we operate in every segment. So there's a new launch market, which is where I think where some of this action is, when you hear of projects getting launched and large builders collecting a lot of checks very quickly. That's mostly with very top, end builders and in sort of the new launch market, right? We have a very tiny share of that market. It doesn't really contribute much to our revenue today. We primarily operate in the under construction sort of segment. So once the project is under construction, there's a lot of some of the project is sold at launch time and then it's sold over a period of time. So that's when we become very important for developers and channel partners. And of course, we operate in the secondary market. Most of the secondary sales go through platforms like ours. So our secondary business is also doing well this year. By the way, it's smaller than the primary business for us, but it's almost as big if you include rental, commercial, resale. And that business has been growing much faster than our primary business. In the new launch, there's a lot of action, business activity, but we don't really play a big role. And that's something we want to correct going forward. That's an opportunity for us. A lot of that revenue today goes to the Facebooks and Googles of the world. The under construction business has been growing at a healthy pace because, what's happening is that demand has been solid and there was not enough supply which hit the market during COVID. And as a result, the unsold inventory in most markets, it is at a decade low. And that's also resulting in higher prices in some pockets. And in general, people want to upgrade after COVID. So all these sort of factors seem to be resulting in a reasonably solid real estate market. And, you have to remember, see, even when we were hit by COVID, even when we were hit by GST, RERA, demonetization, we were able to grow our business at 12-14% per annum. So we would like to grow it much faster going forward in a good market. So, and the team has been executing well. So that's the good news. We are happy with the way the team has been executing. But let's see if this sustains. If with real estate, I've learned it's very hard to make forecasts.
Fair enough. Thanks for the elaborate commentary. I'll rejoin the queue.
Thank you, Vivek. The next question is from Nitin Jain from Fairview Investment. Nitin, go ahead and ask your question. Nitin, you're there?
Nitin is on mute.
Hello, can you hear me now?
Yeah,
we can
go
hear
ahead.
you now.
Yeah, thanks and congratulations on good execution in this tough environment. So regarding the recruitment business, I just wanted a clarification first that, in the past, management has guided that contribution of IT, ITES to revenues around 50%. But in the presentation, like if you look at the last 3-4 years data, it's somewhere in the ballpark of 35%. So can you help me reconcile that?
Yeah, you see, direct revenue from IT companies is in that ballpark, but a lot of recruitment firms also work for IT companies. So if you add, a recruitment revenue from recruitment consultants is also about 30% of our revenue. So if you, proportionately sort of, if you do the math and you sort of, maybe half of that is also, or maybe slightly more than half of that is also IT, connected to IT hiring.
Okay, so the 3 buckets that you have shown, the consultants are outside those 3 buckets, is it?
Which are the
BFSI and infra.
No. See, I don't know which slide you're referring to.
So there is a slide on, hold on.
So there's IT, there's non-IT, and there's consultants. So if these are the 3 buckets you're looking at?
No, so there is IT, ITES, and then there's BFSI, and then there's infra.
That's a data sheet. So there are 3 buckets. One is IT, one is non-IT, and third is... Yeah, I think the buckets to look at are IT, non-IT, and recruitment consultants.
Okay.
That's how we... Because, that the other bucket you're looking at is not... there are 40 different sectors in which we operate.
Okay.
Then I think you should look at our presentation, slide number 26. That will give you a better breakup of the numbers.
Okay.
Recruitment firms is 26% and
27%.
So broadly half of it would be coming from IT businesses. So that will add up to around 50%.
Okay, got it. That's perfect. Thank you. So, and one more thing. So if I add up IT, BFSI, and infra, together they're about 50% of the revenue. So what is in the remaining 50%?
Nitin, maybe you can refer that slide. You'll get complete details.
Okay.
So you have other
Yeah,
sectors
see,
also.
we have, see, we there are 45, 50, 40, 50 different sectors. Yeah, there's BFSI,
Okay.
there's education, FMCG, durables, travel, tourism, hospitality, infrastructure, engineering. So, if
Right.
you add all that, you'll add up to 100%.
Okay. Okay. And what has been a traffic share for the December quarter, like for Naukri?
Similar, I mean, I don't think there's much that has changed on that front.
Okay, just asking because I think earlier the company used to disclose that with the presentation, but
So
I
it
didn't
is
seem to
it is
find
still
it.
there, Nitin. We have been trailing at around 70% plus.
Okay.
Of late, there had been certain issues we are facing with SimilarWeb because the app traffic that we are getting from SimilarWeb doesn't matches with our internal sources. But broadly, you can assume the traffic right now remains at the range of around 70% plus for now.
Okay, great. And I just wanted to understand, how pricing behaves in this kind of an environment, given that, we are probably close to the bottom for the IT sector downturn, hopefully.
I hope so too.
Yeah. So how does the pricing behave in this environment? Like, do we give any kind of
See, it's very hard to
discounts
take
or?
price hike. It's in a soft demand environment, it's hard to take price hikes. So, and it's hard to get volume growth as well. So, it's like, you do your best. We don't get price hikes in this environment. I mean, we are adding new customers in non-IT. We're expanding to small towns in the non-IT on the non-IT side to acquire more customers. And there, if if demand picks up, we should be able to get a price increase, but not on the IT side, and certainly not with consultants. Because consultants are the most impacted when there is a slowdown.
Right. So do we even provide any kind of discounts or something in this environment?
Yeah, it's a negotiation. At the end of the day, it's a negotiation. So while there is a rate card, there is some discounting which happens, and we try and understand how much value we create for the customer, and we equip the sales team with these tools, and then they use them to negotiate with customers.
Right. So regarding the real estate business, I missed your comment on improved pricing realizations. Can you please elaborate once again?
For our business?
Yeah, for real estate.
Yeah. So two things. One is what I may have mentioned is that real estate prices are going up nationally, because the market is hot. So there is more demand than supply right now. And therefore, real estate prices are going up nationally. Of course, in some markets, it's a very local business. There are lots of micro markets. In some real estate markets, prices may be up 100% over last year. Same time, some markets are up 20%. But in general, prices are going up everywhere. And we have also been able to realize, better prices for our listing products in real estate from our customers.
Okay, and would that be from brokers or like individuals as well?
See, we have a very tiny, B2C business. We work mostly with brokers and channel partners.
Okay.
Yeah.
Great. And just one more thing regarding real estate. So the paid listings seem to have declined from last year, but the revenue has seen so I think this ties in with the pricing realization improvement comment, I guess.
Correct.
Right. Okay, great. And just one last question. So at the overall business level, you have seen a good margin improvement in the first 9 months. So what has led to this improvement? Like, have we cut down on marketing expenses significantly? Like the cash
We've
burn in.
reduced. Yeah, see, our burn in both 99acres and Jeevansathi is down over last year, right? And this is primarily because one, in 99acres, the sales are up 24% over last year. Costs are up only 5%. We have spent less money on advertising than last year, but it's not that much less. It's just that we've kept our costs under control, and we are now seeing operating leverage play out. In the Jeevansathi business, we've cut marketing spend substantially because marketing was a big chunk of Jeevansathi expenses, and we started monetizing more aggressively. If you remember, we actually changed our business model. We went freemium. We took a hit on revenue. We tried to gain market share through this route, and now we think we're at a point where we can slowly start, turning the screws on monetization, and that is resulting in higher revenue growth than previous quarters. And at the same time, the market is not as irrational as it was earlier. So we also managed to bring down our marketing spend. So that has led to lower burn in Jeevansathi vis-a-vis last year. So while in Naukri, billing growth has been slow, low, and our costs are up. So, but overall, because of the improvement in Jeevansathi and in the 99 acres business, our margins are perhaps still holding or looking better. May not continue if the Naukri business does not recover in subsequent quarters.
Okay, thanks for the clarification. And just one last one, if I may. So regarding Shiksha, I think the business model seems to be relatively fine-tuned now compared to how it was 3-4 years ago when we were nascent at a nascent stage. So what would it take to scale up this model rapidly now?
I think we need to do a lot more work in the Shiksha business. It is not, in our view, it is not at a stage where we can predict what's going to happen next year or the year after that. I think it requires a lot more work. We are comfortable. We are sort of breaking even, we are growing a little bit. But if we really want to ramp it up, I think we need to do some more homework, go back to the drawing board. So that's on the agenda, but not for the next few months, maybe after that.
Okay, that's it from me. Thank you so much.
Yeah, thanks, Nitin. Next question is from Vijit Jain from Citi. Vijit, go ahead and ask your question.
Thank you. Hi. So my first question is on recruitment. So last time, I think you guys talked about a little bit about, giving more color on the GCC side, what trends are already visible in your numbers and how you look at them. So I'm just wondering if you can shed a little bit more color on that front on the recruitment business. That's my first question.
Yeah, see, our sense of what's happening in the GCC market is that the number of GCCs are growing. But what happened? But the bigger GCCs actually perhaps are not growing as much. So in every market you have an 80-20 sort of thing. So while there may be 1,500-1,700 GCCs on the ground, then when you start a new GCC, typically the new GCC starts small. They start by hiring 20 people, 50 people, 100 people. And when they start, they normally don't use a site like Naukri for hiring. They sort of give the contract to somebody, and that's how they set up their first sort of team. Only when they hit 300, 400, 500 people do sites like us become relevant, because that's when they start having attrition, where they need to grow, add more people, etc., etc. So our sense of what's happening in the GCC market is that while the number of GCCs in India is growing, the newer GCCs are small. They will take time to ramp up. The bigger GCC, on the other hand, the ones which employ a few thousand people, did not grow this year, because they're, these are GCCs which are captives of larger firms. And some of these firms, and these are large US companies or US retailers or US utility companies or US BFSI giants and so on. And they've not been hiring aggressively this year. That is our take.
Got it. Thanks, Hitesh. And my second question is, I think kind of, to both you and Sanjeev, because I saw a tweet from Sanjeev today where he mentioned about, the number of startups which are now hitting sustainable profits is higher than what he thought 16 months back. And I'm just trying to get a sense, is that something you're seeing in spaces where the non-recruitment business for you also competes? So in 99 acres, for example, I do note that housing.com seems to have grown a little less this quarter versus you guys. This is, I think, first time in a few quarters. And I'm wondering if you're seeing the same kind of trend for where Shiksha operates and maybe even Jeevansathi operates. I don't know if it ties in as neatly there as well.
Well, Sanjeev should be able to comment on the broader startup ecosystem, but our general sense of what's happening out there is that because of the, raising capital is not as easy as it was earlier. A lot of businesses are behaving more rationally than they were behaving earlier. That's all. I mean, that's what is happening everywhere, in my view. And maybe Sanjeev can add to that.
Yeah, I think Hitesh has summed it up perfectly. जब पैसा कम होता है तो आपको break even करना पड़ता है. When there is a shortage of money, you have to break even, and I think we're seeing that enough companies are doing that, and more are doing it than I think I had anticipated 16 months ago, and I tweeted that. And in our own portfolio across our funds, we are seeing at least close to double-digit startups that are breaking even, making money, or perhaps getting very close to it.
Okay, that's good to
So
hear,
that
Sanjeev.
if that is what is happening in our own funds, I would imagine what's happening across the ecosystem is running into 100 or 200 or 300.
Got it. Perfect. Thanks, Sanjeev. And my last question, just a clarification on the Shiksha business. You mentioned billing surged by 41%, propelled by early campaigns from domestic clients. So I'm just wondering, is this seasonality shifting or something, or is it that you've gotten some more business from domestic clients versus earlier? I just trying to understand
Yeah, no,
what
I
you
would,
mean
I
when
would
you say
not read
that.
too much into this. A couple of clients, if they start early, it sort of changes our billing growth.
Okay.
A lot depends on the education season. So if JEE mains, for example, is earlier this year, then clients start early, if, stuff like that. So,
Okay.
I would not read too much into it. It's not as if Shiksha is going to start growing at 40% from here on.
Oh, okay. Got it.
Yeah.
Thanks, Hitesh. Those are my questions.
Thanks, Vijit. Next question is from Jaideep from Accent Capital. Jaideep, go ahead and ask your question.
Hi. My question is particularly in the real estate business 99 acres. So the earlier speaker asks around the listings trend as well. So just want to double click on the point. So the listings growth, if I were to tabulate, the growth has been fairly tepid in the last 1.5 year, free plus paid. And on top of that, the share of paid listings has also come off from its peak. So just wanted your comments on that, and then I will ask my second question.
So see, firstly, listing growth is a reflection of the secondary market. Okay, and within listing, there are rental listings, there are resale listings, there are commercial listings, and the situation could be different in different cities. In general, in a hot market, real estate tends to move faster, right? So in a slow market, a listing could be on the site for 6 months, 8 months, because it takes a long time to sell. In a hotter market, you may be able to post and, you may be able to sell in 2 months or 1 month. So there are these factors at work. And so this is the hotter market than what we've seen over the last few years.
Basically, what you're trying to say is the velocity of
Correct.
listings has kind of improved significantly, and hence you see the number come off. And your point on the share of paid listings, I understand that the pricing has improved, but is that taking a toll on the volume of paid listings by any chance? If my understanding is correct on that front.
See, I tell you, we have a freemium model for owners.
Yes.
Right. And we charge brokers. So all broker listings on the platform are paid listings, unless we may be giving some free trials here and there, but that's a very tiny number. While most owner listings are free listings. So the number of brokers we are working with has actually grown over last year substantially.
Okay.
It's just that, what may be happening is that at any point in time, they have fewer listings because, property is moving faster. That's all.
Sure. And since 4Q is typically the strongest quarter for real estate, and particularly because we are operating in the under construction and all this space, so just want to get your sense how, because since we're already halfway there, so how are the early trend is looking like for the quarter?
What happens in our business is that it's a subscription model. There are renewals. A lot of these renewals are around quarter end. Sales teams have targets, and what I see how they work is that they do a lot of new BD in the first 2 months of the quarter, and they focus on collection in the last month of the quarter. Right.
Sure.
Now, so normally, if the market is good, they do well, and but it's hard for me to predict how things will play out. It's, we have some internal sort of modeling which we do, but a lot depends on what happens on the last 4-5 days of the month, of the quarter, actually, not the month.
Sure. And on the reduction of losses, how much has operating leverage aided? Because the top line grew by high teens, right? 22-23%. How much of that is operating leverage, and how much of that is cost optimization, basically the marketing bit?
So in Jeevan Sathi, we
No, I'm talking about 99 acres.
Okay, 99 acres. So our marketing has become more efficient compared to last year. We've made a few changes to our media mix, to our the mix between branding and performance, and stuff like that. And we've optimized our marketing spend. And the optimized marketing spend is actually, the ROI on it is actually higher than on the higher spend last year,
Sure,
right?
sure.
So that's helped. And I'm sure marketing costs are down by how much, I don't know, but maybe by 15% year on year in 99 acres, or maybe 10%, I don't know exactly. We can get back to you. And otherwise costs are up in single digits and revenues are 22%.
Sure, that helps, Siddesh. Thank you.
Marketing expenses are down by 10% year on year for this business.
Thanks, Vivek, for that clarification.
Thanks, Jaydeep. Next question is from Aditya from Mercury. Aditya, please go ahead and ask your question.
Hi, Tej. Good evening. Just two questions. So one was in terms of Naukri. Naukri typically sees a big quarter in March. Any kind of indications here in the March quarter how billings are shaping up?
I wish I knew. I had no idea. No idea at all. I mean, and I checked with Pawan also. He said, listen, we will have a better idea by 15 March. So it's very hard to say.
Because the March quarter has been like you've seen this big kind of like 35-40% kind of bump ups in that quarter. So I was just wondering if
no. So Q on Q definitely will grow. That's a given. But how much we will grow over last year, or whether we will decline over last year, etc., that is unclear to us. I mean, we can't predict right now.
Got it. And are you able to kind of triangulate towards what the current rate of billings kind of really implies for your revenue growth for Naukri next year, even if that's a range which you can point to?
See, a lot will depend on what happens to IT hiring. If our IT hiring business grows by even 10%, then of course it'll be a very different story. But right now our IT growth is negative. It's down maybe 5%, 6% year on year. Our non-IT business is up maybe 7, 8, 10% year on year. So we are at flat or slightly or minus 1%. So a lot will happen, depend on what happens to IT hiring next year. So if IT companies bounce back, if they start hiring like they used to hire even pre-COVID, I mean, that's very good news for us. And if we are able to grow our IT business by 10, 12%, and if we are able to grow our non-IT business by 14, 15%, we can aspire to grow at, and if we, can push our new products faster, we can still aspire to grow at in double digits. But if IT growth does not recover, if IT companies demand doesn't pick up, and then it'll be a challenge.
Thanks, Satish. And as this dynamic kind of plays out, would it be a fair expectation to say that, and we've discussed this previously also, that your operating expenses would largely be steady, so there could be a period of margin erosion to the extent that your volume is soft or your revenue is soft in Naukri?
Actually, we want to continue to invest in the new emerging sort of businesses that we are building, like Job Hai. We would want to continue to actually invest more in Job Hai. That's a blue collar job board we're building. We would continue to sort of make brand marketing investments in Naukri. We are opening new offices. We are hiring more salespeople as we spread to tier 2, tier 3 towns. So these are investments we would like to continue to make. We would want to continue with, irrespective of whether business recovers next quarter or not. So if business recovers, we will be able to maintain margin. If we're able to get to double-digit growth, we might be able to maintain margin. But if growth continues to be slow, our costs will rise next year in Naukri, because we don't want to delay these investments. It's important for the long run.
Thanks, Satish. Thanks for being so candid. And Sanjeev, maybe one for you was that within the investment book, are you seeing any kind of any areas of optimism which you can maybe call out or speak about?
I think by and large, most founders are now a lot more frugal, a lot more cost conscious, a lot more conscious of good unit economics. And that's a broad-based trend. Now, having said that, there will be a few companies who are unable to make the switch and pivot because they got committed to the wrong kind of unit economics and costs early on. may have a challenge getting out of it, but even they are making an effort. But by and large, I think a little shortage of capital is good for discipline, and that's what is happening. So you'll see the fruits of this in the next year or two.
Thanks, Sanjeev. Thank you.
Thanks, Aditya. Next question is from Nitin Sharma from MC Pro Research. Nitin, go ahead and ask your question. Nitin, you are there?
Hello.
Yeah, go
Yeah,
ahead.
yeah. So thank you for taking my question. First of all, with your losses already coming down, competitive intensity seems to be easing. Is there a timeline for the Jeevan Sathi business to turn profitable?
There's no timeline as such. I mean, we are, like I said, working hard on monetizing. We've had moved to a freemium model. So we are experimenting with a bunch of things. Some of them will work, some of them may not work. We saw, some of our experiments paid off last quarter, so we saw healthy growth. Now, of course, we have internal targets and we are working hard to get there. And we would like to break even as quickly as possible. But a lot will depend on one, competitive intensity, and number two, whether these experiments we are working on start yielding results.
Okay, is it fair to assume that your advertisement and promotion costs would be remaining somewhere where they have been this year for first 9 months?
It'll depend on what happens with competition, but yes, I mean, we would not want to, up them significantly at least.
Understood. Thank you.
Thanks, Nitin. Next question is from Vikrant Gupta from ICICI Prudential. Vikrant, go ahead and ask your question.
Yeah, hi. Thanks for the opportunity. So I was wondering if you could provide some commentary on how you are seeing the attrition levels at the IT companies. So at least the publicly available data is more a last 12 months sort of number. So I was wondering if you could provide some color of how maybe attrition is in Jan, Feb versus, December or something like that. What's the latest read that we have?
We don't have access to attrition data. What is available to the public is what is available to us. Everything else is anecdotal. So I would not bank on it.
So anecdotally, what is your sense? Is Jan, Feb lower than December, or is attrition bottoming out or picking up? So
my sense is right, Jan was similar, but I could be wrong.
Okay, thank you.
Not much change. Yeah.
Yeah, thanks, Vikrant. Next question is from Nikhil Chaudhary from Nuvama. Nikhil, go ahead and ask your question.
Hey, hi. Thanks for the opportunity. My first question is regarding the losses we have, especially in Jeevan Sathi and 99acre. But you mentioned that competitive intensity is shifting, and because of the dearth in capital, and which is leading to industry behaving more maturely and moving to break even or even profitable. Is it fair to assume at least in at least near term, or we have some timeline? When can we achieve break even basically in 99acre and Jeevan Sathi?
So listen, we would like to break even as early as possible, and make a profit. I mean, Q4 is normally our best quarter. If we have a good quarter, you may see us generate cash in Q4 and 99acres, depending on where we end up. But we would be very happy to break even next year in 99acres. But a lot would depend on competitive intensity. A lot would depend on whether some of the projects we are working on to improve our monetization, to or to increase our traffic, yield the results we expect them to yield. So we don't want to be irrational. We would like the business to break even as early as possible, but we would not sacrifice growth. So if required, we would spend. If that's where the market is headed, then we will not want to give up market share either. So that's how we are thinking about this right now.
Sure. Second is just in case a scenario IT do not pick up meaningfully, let's say in a hypothetical scenario, and non-IT continue to do well, what we are already seeing, right? Can we still grow in double digit on the back of some improvement in pricing plus non-IT being very good, given you're already investing in tier 2, tier 3 cities, as well as what we were seeing in Naukri Gulf doing better? Can that happen, or it will be very difficult?
No, we want, so IT right now, IT growth is perhaps -6-7%. Consultants are at -8-10%. We need to at least get IT back to base year. So we need to get to a situation where IT companies at least start growing a little bit over last year. At least 3-4-5% over last year. So while they seem like they are distinct markets, they are somewhere also connected. Because at the junior level, talent supply is often fungible. People want jobs. If they're not able to get jobs in IT companies, they take up non-IT jobs. That's how it works, And so our sense right now is that IT attrition rates are low. So if there's a spike in attrition, of course, it benefits our business. Attrition rates are lower than perhaps they've ever been in the last 7-8 years for IT companies. If they go back to even COVID levels, we'll get a double-digit growth. And if IT hiring picks up, it'll also impact non-IT attrition, in some businesses and in some companies. And that will also lead to a spike in non-IT growth, right? And actually, when companies start doing well and they look and, things look good, it's actually good for our new products also. So they spend more money on branding. They will want to buy software. They will want to do more assessment. So somewhere they're all connected. Our sense is that if IT companies recover, then our business will, of course, do very well, assuming, of course, that the economy continues to grow at whatever rate it's growing. And on the other hand, if IT continues to be very, very sluggish, it'll be hard for us to hit even double-digit growth.
Sure, understood. Very helpful. Thank you.
Thanks, Nikhil. Next question is from Salil Desai. Salil, go ahead and ask your question.
Thanks, Anand. Hitesh, I just want to make sure I understood Jeevan Sathi right. So based on all your responses, is it fair to assume that you figured out what the model is and this is the way to go? It's been about a year since you've been trying these experiments.
So we're not going back to the old model. This is the model we are continuing with. We are, just sort of now trying to figure out how to monetize better because we went free, right? And therefore, and as a result, we lost 30% of our revenue, our top line. And now we're just sort of trying to figure out what should remain free, what should we start charging for, how can we sort of leverage the traffic we have to, get 30% growth, 25% growth over last year. The team is experimenting with a bunch of things. Let's see how this plays out.
Right. And here, again, if I understand this right, it is not something so difficult that the competition cannot replicate, right? So, how are you seeing their response to?
No, they can replicate it. It's just that they will have to take a 30% dip in revenue.
Right. So you think it's a kind of psychological barrier for somebody to.
And what is in it for them? See, we did this because we wanted more profiles. We wanted the network effect to sort of start working for us. We were a number 3 player. So we were getting maybe only 50% of the profiles in the market. And we wanted to go to 70% or 65%. They're already getting 70-80% of the profiles in the market, right? Because they're leaders in the markets they operate. So the cost benefit analysis may not necessarily work out for them.
Understood. Perfect. Great. Second question I had was, the commitments that you have made to IEVF. I'm not sure if you disclose this number, that how much of it is actually deployed and given to them.
To whom, sorry?
To the venture fund.
AIFs.
Oh, AIFs.
The AIFs, there's a commitment, right? And there must be some drawdown. So is there a number where this is what you actually invested in them?
Do we make it public? So the commitment was announced earlier, and there are 4 funds totally. And fund 1 was 750 crores. Fund 2, fund 1 follow-on 750 crores. Fund 2 was 150 million into whatever the exchange was then. And then there was a capital to be was 75 million. And then a third LP joined and committed some more money across all 3 funds. But if you look at what we have committed, It's 37.5 million plus 75 million plus plus 100 million.
212.5 million.
And that is still a commitment. That is not what you would have actually,
Well,
got a check in.
a lot of it is drawn down and some of it is remaining.
All right, great. And Sanjeev, again, going back to what you were talking about. So on one hand, there is capital is becoming a little more scarce for startups to. I mean, it's not so easy to raise money. And on the other hand, we are seeing that now the secondary markets seem to be a little more willing to take risks with loss-making startups. Do you think now
when you say secondary market, what do you mean?
I mean, public markets. I'm saying not
public
markets. Sorry.
Yeah.
So you think the route to IPO kind of shortens for most people, that if the private markets aren't as charitable.
My submission is that after 2022, the market correction, while technically loss-making company can go public, I think I'm doubtful as to how receptive public markets will be for loss-making companies, unless there's very clear visibility of profit in the next year or two. But I'm not sure that people will be willing to really give loss-making companies the kind of valuations that these companies hope and expect.
Understood. Thank you so much.
But I could be wrong. Markets. You guys know better. You're public market investors. I mean, you tell me. Would you invest in a loss-making?
No, like I said, there seems to be people seem to be more receptive now, right? There's one.
I think that window was there for a while, but with the correction in 2022, I'm not sure. How many people will still be willing. I mean, if you look at the sort of rise in the share price of Zomato and a Policy Bazaar in the last 6, 8 months, 10 months, 12 months, it's coincided with the improvement in the bottom line.
Absolutely.
Maybe there's a cause and effect there.
Got it. Thanks, Sanjeev.
Thank you, Salil. Vivek from Ambit Capital is back. So Vivek, go ahead and ask your question.
Hey, just following up on Salil's questions. So Sanjeev, it's been almost 2 years since the new money was earmarked for the AIFs.
Yes.
At that time, you had said that you will deploy the funds in 3 years. Has anything changed? So will you end up deploying?
We are investing a lot slower than we initially imagined. We are writing smaller first checks. We are taking our time. We are investing at a slightly lower valuation than earlier. And that, I think, is consistent with market conditions. And we think that's a smart thing to do, a more prudent thing to do. So yeah, it may not happen in 3 years, may take a little longer. But listen, when you say 3 years deployment, it meant we will give our first checks into companies in 3 years. Obviously, the follow-on checks will go in over the next 4, 5, 6 years.
Okay, and when you said that, you meant that the follow-on checks would also be coming from the same AIFs, or would that entail? Okay,
no,
okay.
Same AIFs. We don't want any conflict of interest with having 2 different funds in our stable investing in the same company.
Understood, sir. And just one more follow-up. Recently, the government permitted overseas listings in GIFT City. Do you think that will be a game changer in any way as far as Indian startups are concerned in any sector or any segment?
Too early to say. Too early to say. But what has emerged is that while there was a lot of clamor, say 4, 5 years ago, to be allowed to list in the US, even though you're domiciled in India, what seems to have emerged is that the Indian markets have been giving better IPOs to Indian startups than the US markets. Because I think the threshold turnover size valuation requirement for US listings is much higher than India. It's harder to get research coverage. And therefore, I think only one company went public in the US as compared to, I think, more than a dozen in India. So it's pretty clear that even if you allow overseas listings, Indian startups might prefer listings in India because that's where the investors are for their companies.
Okay, thank you. That's a great perspective. And
if you list through GIFT City, I think the rules are such that you are cutting out the Indian investors. And
I see.
I think so. I'm not sure. And if you do that, I think you may have a bigger challenge. Getting your IPO to succeed.
Okay, understood. And Sanjeev, you had mentioned about 5 companies that you had invested in during the 2016 to 19 period. Have any of them?
They're more than 5. They're more than 5, but there are the promising ones are Ship C, Adda 24/7. Shop, a couple of others. But yeah, look, there'll be a while before they sort of get to go public or make profit.
Understood. Thank you so much and all the best.
Yeah, thank you.
Thanks, Vivek. Vivek, this was the last question for the day.
Okay. Thanks everyone. On behalf of InfoEdge, we conclude this conference. You may disconnect your lines now.
Thank you, everyone. Have a great evening.
Thank you.
Thank you, everyone.
Bye.